Hi there, it's Friday the 20th of September 2019. I'm Steve Towers. Welcome to ITB, coming to you today from Nagoya in Japan. Let's get started. This must be the calm before the storm in regard to digital taxation. There have been no significant developments this week. In fact, the only item worth mentioning is that the incoming EU Tax Commissioner, Paolo Gentiloni, said in an interview this week that if a global solution does not emerge in 2020, the EU should again pursue its own unilateral solution, which is not surprising. It looks like there's been some small peace offerings in the China-US trade war. On the 11th of September, yes, that date, China announced a list of 16 tariff items which will be exempt from its tariff increases. And on the same day, President Trump announced, as a gesture of goodwill, that the US tariff increase, which was scheduled to take effect on the 1st of October, would be delayed until the 15th of October, by which time, of course, high-level negotiations between the two countries should be taking place in Washington. The OECD has released its 2018 MAP statistics report, covering 89 jurisdictions and, according to the OECD, almost all MAP cases worldwide. Let me take you through the highlights. The inventory of MAP cases just keeps increasing. Compared to 2017, new transfer pricing cases in 2018 are up by almost 20% and other cases by more than 10%. But there's been no significant change in timelines. On average, transfer pricing cases continue to take more time. 33 months for transfer pricing cases and 14 months for other cases. And more than 80% of MAPs which were concluded in 2018 resolved the issue in dispute for transfer pricing cases and more than 75% for other cases. For the link to this report, please go to our website or app. In Australia, commentators have suggested that the government will likely soon announce the repeal of the offshore banking unit regime in response to adverse feedback from the OECD's Forum on Harmful Tax Practices. The OBU regime currently provides a 10% corporate income tax rate and an interest withholding tax exemption. In India, in regard to transfer pricing, the government has announced the retention of the existing tolerance limits for the application of the arithmetic mean rule. India's primary approach for showing compliance with the arm's length principle is the use of a range of comparables, not an interquartile range, but a range from the 35th to the 65th percentiles. If, however, the range approach can't be used, for example, if there are insufficient comparables, then the arm's length price is determined by calculating the arithmetic mean of the available comparables, and then applying a tolerance limit of 1% for wholesale trading and 3% for other transactions. Those existing tolerance limits have been retained in the government's announcement. For a copy of the announcement, please go to our website or app. Also in India, the Supreme Court has decided a case in regard to the export incentive benefit under the income tax law for so-called supporting manufacturers. Under the relevant provision, direct exporters, which are called export houses or trading houses are entitled to a significant income tax deduction. Supporting manufacturers are taxpayers which manufacture and sell goods to export houses and trading houses where the goods are ultimately exported. Supporting manufacturers are also entitled to an income tax deduction under the relevant provision, but it is smaller than the deduction available to export houses and trading houses. Although the provision appears quite straightforward, there was an earlier case which held that supporting manufacturers were entitled to the same level of deduction as the export houses and trading houses. The Supreme Court has now overruled that earlier case and applied the clear words in the provision. Supporting manufacturers are entitled to a smaller deduction. For a copy of this case, please go to our website or app. And speaking of export incentives, the Indian government has announced a series of measures to boost economic growth, including measures focused on boosting exports. These measures were announced in a press conference given by the Finance Minister last Saturday. In regard to exports, the key measure is a new scheme called Remission of Duties or Taxes on Export Product, or RoDTEP, which will replace the existing Merchandise Export Incentive Scheme, effective the 1st of January 2020. I wish I could tell you that significant details have been announced, but they haven't so far. For a copy of the presentation deck used by the Finance Minister in her press conference, please go to our website or app. And today, the Finance Minister gave another press conference to announce another set of tax changes to boost the economy. I have to say that it's looking like the state of the economy has rattled the Indian government. The headline changes in today's press conference concern corporate tax rates. Firstly, companies will have the option to pay income tax at the rate of 22%, subject to the condition that they do not use any exemption or incentive. The 22% rate translates into an effective rate of 25.17% after surcharge and cess are added. Also, such companies will be exempt from minimum alternate tax. Secondly, new manufacturing companies will have the option to pay income tax at the rate of 15%, again subject to the condition that they do not use any exemption or incentive, and also provided they commence production by the 31st of March 2023. With surcharge and cess, the effective rate will be 17.01%. Also, such companies will be exempt from minimum alternate tax. And thirdly, the rate of minimum alternate tax has been reduced from 18.5% to 15%. For a copy of the Finance Minister's press release, please go to our website or app. And finally, in India, the Delhi Income Tax Appellate Tribunal has decided a case concerning the PE definition in the India-Singapore Treaty. The taxpayer is Hitachi High Technologies Singapore, which is a Singapore resident company with major trading operations in Asia. The taxpayer has operated a liaison office in India for many years. The tribunal concluded that due to its activities, the liaison office constituted a fixed place of business PE under Article 5(1) of the treaty. There are 2 points to note with this case. The first point is that in determining the activities of the employees who were based at the liaison office, the Indian tax authorities reviewed the emails sent and received by those employees. Those emails, together with other evidence, showed that the employees' activities went beyond preparatory or auxiliary activities. We've seen the Indian tax authorities use emails for this purpose in other cases, most notably the GE Energy Parts case. The tribunal said this: the employees were engaged into marketing, sales promotion, and market research activities, which are sine qua non for a trading business, that is, the taxpayer's business. The LO was actively involved in ascertaining customer requirements, price negotiation, obtaining of purchase orders, following up on delivery of material, and payments. None of these activities can be termed as having preparatory or auxiliary character. The LO was directly participating in core activities of the trading business of the taxpayer. And the second point to note is that the preparatory or auxiliary exception is expressed in an unusual way in the India-Singapore Treaty. The relevant provision is Article 5(7)(e), which says this: notwithstanding the preceding provisions of this article, the term permanent establishment shall be deemed not to include (e) the maintenance of a fixed place of business solely for the purpose of advertising, for the supply of information, for scientific research, or for similar activities which have a preparatory or auxiliary character for the enterprise. Article 5(7) has the same structure as Article 5(4) in the OECD and UN model treaties, but you will notice that paragraph E is different in two ways. Firstly, there are the specific references to advertising, supply of information, and scientific research. Those items are not mentioned in the two model treaties. And secondly, the preparatory or auxiliary character clause has the introductory words "or for similar activities." The tribunal said that those words require the iustum generis principle to be used, which has the effect of narrowing the preparatory or auxiliary character exception. For a copy of this case, please go to our website or app. In Malaysia, the customs authorities have issued a policy statement in regard to the imposition of service tax on services imported into Labuan. According to the policy statement, for the period from the 1st of September 2019 to the 31st of August 2020, companies in Labuan will be exempt from service tax on such services, subject to conditions. For a copy of the policy statement, please go to our website or app. In the Philippines, the tax authorities have issued guidelines for the conduct of transfer pricing audits. For a copy of the guidelines, please go to our website or app. In Sri Lanka, the government has announced that it will introduce into Parliament a bill to impose a 3.5% tax on outbound commercial payments made by debit or credit cards. The tax would apply to such payments in regard to the purchase of goods or services. In Austria, the tax authorities have issued guidance in regard to Article 13(2) of the Austria-UK Double Tax Treaty, which deals with the sale of shares in a land-rich company. Article 13(2) uses the phrase immovable property. In the guidance, the tax authorities considered the situation where an Austrian company owned a fibre optic network. The tax authorities said that Article 13(2) is related to Article 6(2), which defines immovable property according to the law of the contracting state in which the property is situated. Based on Austrian case law, the tax authorities concluded that the fibre optic network constitutes immovable property for the purposes of both provisions. For a copy of this guidance, please go to our website or app. In Belgium, the tax authorities have released a circular letter on the application of the grandfathering provision in the recently introduced interest limitation rule. Under the grandfathering provision, loans which were issued before the 17th of June 2016 and which have not been fundamentally modified since that date are excluded from the interest limitation rule. The circular letter provides guidance on the meaning of fundamentally modified. For a copy of the circular letter, please go to our website or app. In Denmark, the government has released for public comments a draft bill which will make changes in regard to CFC rules, the domestic law definition of permanent establishment, transfer pricing documentation, and a deduction for final losses in foreign entities. Public comments are requested by the 10th of October. For a copy of the relevant documents, please go to our website or app. Also in Denmark, the tax board has issued a ruling in regard to the application of the PE definition in the Denmark-Germany Treaty to an employee's home office. A German company employed a Danish engineer to be its country manager Nordic. In that role, the employee undertook significant business travel in Nordic countries, and for the rest of the time worked from a home office in his private residence in Denmark. The employee's role included these activities: technical support of the company's customers, find and develop new customers, support existing customers, negotiate contracts, and report to the company's global director sales about activities. The employee had no authority to conclude contracts on behalf of the company. The ruling determines that the home office is a fixed place of business PE of the German company. For a copy of the ruling, please go to our website or app. The European Court of Justice has decided two cases which I will only briefly mention. The first case concerns the VAT exemption for the provision of medical care. The case deals with the issue of whether the VAT exemption applies to clinical chemistry and laboratory diagnostics. The second case concerns the interpretation of the EU's merger directives. It relates to the calculation of capital gains tax in regard to an exchange of securities. For a copy of these two decisions, please go to our website or app. The European General Court has been busy with tax-related state aid cases this week. Firstly, the court delivered its decisions in two sets of joint cases which deal with excise tax exemptions for fuels used in metal manufacturing. The first set of joint cases concern Italian excise tax, and the second set concern Irish excise tax. In both sets of joint cases, the court held that the excise tax exemptions constituted illegal state aid. For a copy of the court's two decisions, please go to our website or app. But of course, the main event this week was the start of the case concerning the Irish tax rulings issued to Apple. This is also a set of two joint cases. The court has not given any indication of when its decision will be given, but the court is scheduled to give its decision next Tuesday in two other high-profile state aid cases concerning Starbucks and Fiat Chrysler. And also in regard to state aid, the European Commission has announced that it has opened in-depth investigations concerning excess profit tax rulings granted by Belgium to 39 multinationals. You'll remember that the Commission first challenged these excess profit rulings on the basis that the ruling regime was an aid scheme. That was unsuccessful. The European General Court decided against the Commission in February this year. The reasons given by the court for that decision do not impact on the issue of whether each ruling constitutes illegal state aid for the relevant multinational. And so the Commission has now embarked on the more costly approach, 39 separate investigations. For a copy of the Commission's press release on this matter, please go to our website or app. It's been reported that at last week's informal ECOFIN meeting, which was held behind closed doors, there was lots of discussion but no agreement on 3 related tax topics concerning climate change. Whether the 2003 Energy Tax Directive should be updated, and if so, in what way? Should an aviation fuel tax be introduced? And should a carbon border tax be introduced? In regard to a carbon border tax, France's Finance Minister Bruno Le Maire said this: "Without a carbon border tax, our companies will be at a major competitive disadvantage to companies from the United States and from Asian countries that do not commit to a transition away from a carbon economy." And the European Commission has published a report which evaluates the EU's Administrative Cooperation Directive. For a copy of the report, please go to our website or app. In France, Google Ireland has settled its tax dispute with the French tax authorities in regard to the existence of a PE in France. Under the settlement, Google Ireland will pay a total of 965 million euros, which is part tax and part penalty. You'll remember that Google Ireland was successful in the Paris Administrative Court of Appeal in April in regard to this dispute. However, it was reported that the tax authorities had commenced a criminal case under new legislation. Both the civil and criminal cases have been resolved by this settlement. The District Court of Paris has approved the settlement. For a copy of the court statement, please go to our website or app. Also in France, the government has announced that it has joined the Voluntary International Compliance Assurance Program, ICAP. It will be the 18th country involved with the program. In Italy, the tax authorities have published a ruling in regard to the exemption from withholding tax on dividends paid by an Italian subsidiary to its non-resident parent. The parent was originally a Luxembourg company. However, it transferred its legal domicile to Switzerland with legal entity continuity. As a Luxembourg company, the EU Parent Subsidiary Directive would apply. As a Swiss company, a similar dividend tax exemption applies. Due to the legal entity continuity, the ruling states that the Swiss parent will be considered to have held the shares for a continuous period before and after the transfer of domicile. For a copy of this ruling, please go to our website or app. In the Netherlands, the government has presented its 2020 tax plan. Here are the items that caught my eye. Firstly, the proposed reductions in the corporate income tax rate have been amended. There will be no change to the proposed reductions for taxable income up to and including 200,000 euros. However, there are changes for taxable income above 200,000 euros. In 2020, the current rate of 25% will remain instead of being reduced to 22.55%. And in 2021, the rate will become 21.7% instead of 20.5%. Secondly, the government has finalised its plan in regard to the so-called conditional withholding tax on certain outbound payments of interest and royalties. You might remember that this proposal was announced by the government in 2018. Under the final plan, the rate of withholding tax will be 21.7%. It will apply to gross payments of interest, which will be broadly defined, and royalties, which will be defined in the same way as in the OECD Model Treaty. It will apply to such payments to related companies in low-tax jurisdictions and abusive situations. A low-tax jurisdiction is a jurisdiction with a statutory corporate income tax rate of less than 9%, for example, the UAE, or which is on the EU's list of non-cooperative jurisdictions. If the Netherlands has a treaty with a low-tax jurisdiction, the withholding tax will be delayed for 3 years, which will enable the treaty to be renegotiated to allow the withholding tax to apply. The third notable change is that the tax rate for the innovation box will increase from 7% to 9%, effective 2021. A fourth change is that the domestic law definition of permanent establishment will be amended to be the same as in the relevant double tax treaty. Or if it's a non-treaty situation, it will be the same as in the MLI. A fifth announced change concerns the deduction which arises from liquidation of foreign subsidiaries or the termination of foreign activities. The Finance Minister wrote this in his letter to Parliament. Subject to certain conditions, corporation taxpayers can currently deduct, without limit, losses arising from the liquidation of foreign subsidiaries or the termination of foreign activities from the profits they make in the Netherlands. The facility will be amended so that businesses make less use of it. The aim is to prevent liquidation and termination losses being claimed for subsidiaries and permanent establishments outside the European Union and the European Economic Area, and curb the ability to plan such losses. A sixth change is that a thin capitalization rule will be introduced for banks and insurance companies, effective for years commencing on or after the 1st of January 2020. This proposal is substantially consistent with draft legislation which was subject to public consultation earlier this year. And finally, the reduced VAT rate of 9% will apply to the supply of electronic publications effective the 1st of January 2020. For a copy of the government's documents and the letter sent to Parliament, please go to our website or app. In Portugal, Parliament has approved a law which sets out the tax regime for Portuguese REITs. For a copy of the new law, please go to our website or app. In Nigeria, the Finance Minister has corrected her statement in regard to the proposed increase in the standard rate of VAT. Instead of 7.2%, as she stated last week, it will be 7.5%, effective the 1st of January 2020. In South Africa, the Supreme Court has decided an interesting case in regard to expatriate employees of the BMW Group. The South African income tax compliance obligations for the expat employees were attended to by several tax advisory firms under contracts with the BMW South Africa Employer Company and not with the employees themselves. That service was part of the BMW tax equalisation program. The tax advisory firms billed the BMW South Africa employer company for the services. The tax authorities claimed, and the Supreme Court agreed, that the fees which were billed to the employer company constituted taxable income for the expat employees. For a copy of this case, please go to our website or app. Also in South Africa, the tax authorities have issued 2 items of guidance. The first is a comprehensive guide to dividends tax, and the second is a draft interpretation note on the rebate and deduction of foreign taxes. Public comments on the interpretation note are requested by the 15th of November. For a copy of these 2 items of guidance, please go to our website or app. In the UAE, the government has issued detailed rules on the application of the country's economic substance regulations, which are effective from the 30th of April this year. For a copy of the detailed rules, please go to our website or app. And now to Mexico. In last week's ITB, I gave you some highlights from the country's 2020 budget. Let me quickly go through some other interesting items included in the budget. Foreign transparent entities will be treated as taxable entities for Mexican income tax purposes. Operators of digital platforms will be required to withhold Mexican income tax on payments to Mexican resident individuals who sell goods or services through their platforms. This obligation will apply regardless of whether the operator is resident or not in Mexico, and if non-resident, regardless of whether the operator has a PE in Mexico. A GAR will be introduced, and mandatory reporting requirements for certain tax planning arrangements will be introduced. In Peru, the tax authorities have published guidance in regard to the deemed Peruvian source rule for outbound payments for digital services. The guidance considers whether a particular transaction in regard to online software falls within the deemed source rule. For a copy of this guidance, please go to our website or app. In the US, Treasury and the IRS have released final regulations and additional proposed regulations regarding the additional first-year depreciation deduction under Section 168K. For a copy of the 2 sets of regulations, please go to our website or app. And also in the US, the Congressional Research Service has released another report on US tariffs. This new report is called Retaliatory Tariffs and US Agriculture. For a copy of the report, please go to our website or app. And now for this week's treaty developments. And again, a very slow week. All we've had is 1 treaty signed. I have 2 articles for you this week. The first article is called Notional Interest Deduction Regimes in Europe through the prism of ATAD2 and domestic anti-hybrid mismatch rules. It's written by Konstantin Karayanov and it's published in IBFD's European Taxation Journal. As I'm sure you know, notional interest deduction regimes currently operate in a number of EU member states. For example, Belgium, Cyprus, Italy, and Malta. This article considers how such regimes are treated under BEPS Action 2 and the anti-hybrid mismatch rules in the EU's ATAD 2 and the UK's TIOPA. Their favourable treatment is explained by the author in this way. Although one may argue that application of the NID produces a DNI outcome, since the corresponding notional interest income is not recognised in the shareholder jurisdiction, it is not the hybridity that leads to such an outcome. The main driver for the introduction of an NID mechanism is to eliminate debt bias, where taxpayers opt to structure their investments as debt rather than equity. It would thus be inconsistent for states striving to eliminate the debt bias to extend the application of the anti-hybrid mismatch rules to the NID, thus offsetting any positive effect that can be achieved by the NID mechanism in reducing the bias between debt and equity. The article also describes the different treatment of NID regimes under the US anti-hybrid rules. The author writes this: "The bottom line is that the US anti-hybrid rules will significantly affect the use of NID mechanisms within structures involving US companies. The scope and wording employed by sections 245A and 267A allows for anti-hybrid countermeasures to be triggered even when the NID is applied at the level of a low-tier subsidiary, without a direct effect on the US counterparty. By explicitly referencing the NID as an example of targeted deductions, US lawmakers did not leave much room for argumentation in favour of excluding the NID from the scope of anti-hybrid rules." The second article is called "Swimming Against the Current: Taxation of the Digitalized Economy in Latin America." This article has 10 authors. I won't read out the names. And it's published in the IBFD's Bulletin for International Taxation. The article covers 8 countries in Latin America: Argentina, Brazil, Chile, Colombia, Costa Rica, Mexico, Peru, and Uruguay. The article adopts a common format for each country, except where a topic is irrelevant for a particular country: introductory remarks, direct taxation, indirect taxation, and subnational taxes. The article concludes in this way: "The uncoordinated unilateral measures in the Latin American countries under review in general focus on taxing digital services provided by non-resident providers by way of indirect taxes. In Argentina, Chile, currently only a legislative proposal, Colombia, Costa Rica, Mexico, currently also a legislative proposal, Peru and Uruguay by levying VAT, and in Brazil at a subnational level using the ICMS and the ISS. Mexico is currently the only country analysing the possible implementation of a digital service tax, after the proposals to implement such a tax were dismissed in Argentina and Chile, and instead were converted into amendments to, or in Chile's case, a proposal to amend the relevant VAT rules. Let me just comment that I would not call the imposition of VAT on inbound digital services an uncoordinated unilateral measure, if that's meant to suggest that many other countries are not doing the same thing. They are. And the article also says this: from a direct taxation perspective, only 2 countries have broadened their source rules to tax services provided from abroad through digital means without a physical presence in the country. That is Peru and Uruguay. To date, Mexico is the only country under review discussing the possibility of including a digital PE rule. Well, that's the way it is this Friday, the 20th of September 2019. I'm Steve Towers in Nagoya. Have a great weekend.